You. Thank you for joining us. Now, we have seen, as was touched on there, Monty Paschi's debt for equity swap extended. Germany, however, warning about state aid. Again, what does this tell us about the health and the politics within the Eurozone economy at present?
Yeah, good morning, Natalie. I guess Germany is still holding firm on its line there that kind of any kind of taxpayer support, without bailing in some of the creditors up the capital structure would constitute state aid and is not allowed under EU rules. But we've seen that time and time again that the governments do work around those regulations to try and support the bank. As the report said, the government is rumoured to be reporting, it's still press speculation at the moment, of 15 billion in terms of state aid for Monte Paschi and other Italian banks, which are still saddled with some fairly large bad loans, non-performing assets that are looked to be hived off into so-called bad banks, so that the remaining bank can build up its asset base and asset quality and then continue as a going concern. There's still a lot of uncertainty as to whether or not Monte Paschi will be able to raise up to 5 billion of equity. As you rightly say, there's a portion of that in terms of the retail component. There's around about 35% is going to retail investors, 65% is looking for the institutional market. And it's difficult times in Italy. Obviously, we've just got a new government in there, and it's also a very quiet time for financial markets as we go into the Christmas period, and they have that 31st of December deadline. And then in terms of the debt for equity swap as well, there's the tier 1, tier 2 hybrids, 4.5 billion of those, of which up to 1 billion of the new 2008 hybrid, which are nicknamed Fresh. They're offering to convert those at 23 cents in the euro. So again, those hybrid holders are looking at a significant haircut to try and aid and inject some capital into the banking system and into Monte Paschi. So there's a lot of moving parts there, but again, I think it just highlights the weakness of some banks within the European Union and the fact that they still have bad loans, non-performing assets on their balance sheet that they haven't taken the write-downs with, and will have to do it sometime in the future.
On the global calendar today, we're also set to hear from US Fed Chair Janet Yellen overnight. In fact, she's speaking at 5:30 a.m. tomorrow morning in Sydney time. However, no sooner does the US Federal Reserve act than we have more Fed speak coming through. Comments from Fed member Bullard discussing his thoughts on the US Central Bank's balance sheet, saying they should be reducing that. But also comments coming through from Richmond Fed President Jeffrey Lacker, saying it's likely more than 3 rate hikes will be needed in 2017. He says the U.S. economy will get some fiscal stimulus under the Trump administration, which could push the Federal Reserve to raise interest rates more quickly, saying at least some measure of fiscal stimulus appears likely. If we get behind it, it's hard to really calibrate. Certainly, I mean, how are we set to be taking this commentary if the US Federal Reserve have only just already surprised markets, as it were, with expectations of 3 hikes next year, and already, Lacker coming out and saying that there should be more, essentially?
Yeah, I don't think it will surprise the markets too much. The Richmond Fed President Lacker is a notable hawk and has always been on that side of the ledger. So the fact that he's talking up, potential future rate hikes shouldn't come as a huge surprise to the markets. And in any case, he's not a voting FOMC member until 2018. So he's a fair way away to getting those views actually even expressed in the votes. But you're right in terms of that. Initial shock after the FOMC's decision to hike rates by 25 basis points in terms of those blue dot plots and what they mean. I think in terms of the expectations, 3 next year and 3 in 2018 as well, and that was above the consensus and the previous guidance in September of 2. And again, I think it continues to boil down to the fact in terms of how the FOMC and the Fed have been positioned in the markets in terms of this year as well. We started this year with 4 potential hikes. We only got 1, and that is exactly the right way to position the markets. It's always better to say, look, we're going to hike, and in the data, or whatever reason, they don't hike, rather than spooking the markets and surprising them with a hike. And I think that's exactly the right right way to play the markets. And I think James Bullard, the St. Louis president, he's also changing his forecast as well, whereas he was only expecting one hike before the end of 2019. He's actually expecting maybe one hike in 2017, and I think that's probably a more fair reflection of where it'll actually be. I think it'd be between 1 and 2 rather than 3 and higher. And the markets and the yield curve has reacted to that, and you have seen that steepening and kind of shift higher to reflect those higher rate expectations. And I'm still not convinced, as we've talked about previously, that that fiscal stimulus will actually lead to any kind of significant inflation coming through in the United States or more broadly globally. And I still think there's lots of economies around the world, lots of regions around the world where economic growth is fairly tepid. And I think the monetary policy from the ECB and the Bank of England will continue to be fairly accommodative in terms of what they're trying to achieve in terms of the growth and economic stimulus packages on the monetary side for those regions and countries. And I think the US is in a fairly unique situation that it's actually starting to twist around and starting to hike rates and trying to look out for potential signs of inflation, which I'm not massively convinced will come through because of the fiscal spend.